Welcome back, Alpha Hunters. Okay, so today we're going to talk a little bit about hedging and hedging with options. Actually, we're just going to talk mostly about hedging with options, but we're briefly going to go over just like what hedging is for those that just don't know. Just a brief overview. So hedging is a kind of investment position to offset potential losses from reduced value in core or main positions. So value change of the hedge asset is an inverse of the core position. And basically you can think about it like this. We have a core position and then we take on a hedge position, okay? And then as the core position goes up, we can expect the hedge position to go down in value. And then obviously the inverse of that's going to happen to where if the core position goes down in value, the hedge asset will go up in value. Now typically this won't be a one-to-one, but it is meant to kind of help flatten out losses and potential upside. So as the asset kind of moves, you're not really expecting to make a $1 move up in the asset, a $1 move up in your portfolio, as there will be a loss either on the core side or the hedge side. It's kind of meant to flatten out your value gain as the underlying asset moves. So there are several ways to hedge. You can portfolio rebalance, use stocks, bonds, forex, etc. But we are going to talk about hedging with options. Now there's going to be three different levels here about hedging with options, but the first level is really going to be hedging the stock. This is where for every 100 shares, you purchase one put contract. So for instance, if you have 600 shares owned, then you'd buy 6 puts to hedge. Now this won't fully hedge your delta, and it's also known as under hedging. But if you do take on this kind of hedging style, this will be a bullish delta for your portfolio. Now the next level is going to be called delta hedging. So this is where stock ownership has a delta of 1 and your options contracts don't. So let's say those puts you're looking to buy are going to have a delta of 0.4. Then additional contracts are going to be needed to offset the delta. And what you want to do is you want to average the delta of the put you are going to purchase and then the expected future delta. So in this instance, I've already told you we're going to use a delta of 0.4, and then maybe we expect the underlying asset to fall to where the strike prices have a delta of, let's say, 0.7, okay? So what we will do is we will take that delta of 1, and then we will divide it by the average of 0.4 and 0.7, and we will get an average of 0.55. So we will take then that number of 1 divided by 0.55 and then multiply it by the 600 shares, right? We had 600 shares owned. Now that will come to roughly 1,100 shares or 11 puts. So therefore, we need to purchase 5 additional puts to offset the delta. Okay, so we would be buying 6 puts, right, to hedge the stock of 600 shares. And then we'd be buying the 5 additional puts to offset the delta. Okay, so this would be a neutral delta hedging strategy. Now the last level is going to be over hedging. Okay, there's a strong possibility for stock values to decline and you don't want to sell your positions. Now what you do is you use the same formula above to find your delta hedge, but then you want to increase past that by however many number of puts, and this is just where it's kind of open to you on how many extra puts you would like to have in your portfolio. So in this case, we would get to a delta hedge of 11 puts. And let's say we wanted to go 3 past that, we'd buy 14 puts. And then we would have a bearish delta in our portfolio. Now, if you're wondering, okay, well, when do I kind of use each one of these? Well, this is kind of my little guideline. So I would have to hedge the stock position. I would definitely say there's limited upside with downside a little bit more likely. Maybe not massive downside, but maybe it's been on a pretty strong run recently and maybe it's just due for a little bit of a pullback. And then for the delta hedge, there starts to be signs of more of the stock or market issues. There could be a little bit more downside than just a pullback. Now for overhedging, you have an expectation that there are elevated levels of downside risk, maybe even a possibility of a recession. This is where you definitely want to say, hey, you know what, I'm going to overhedge a little bit and maybe make a little bit of money on the downside, but I don't want to sell out my stock position, that kind of thing. So these are the 3 different tiers that I kind of go with. And really, it's not one to where you just jump from all-time highs maybe on your stock or the market and you go straight to overhedging. It's really one of those things where it's kind of like a stepping stone. You know, maybe you buy a little bit of a hedge on your stocks, and then as you kind of see how things work out, you kind of work up to, you know, delta hedging, and then you're like, okay, I can see some more downside than just a pullback, and then maybe you go with an overhedge or that kind of thing. So it's kind of meant to be like a little bit of a building block. So let me go ahead and transition over to the broker, and I'll show you some risk profile charts of kind of what you can expect from each one of these three. Okay, so I'm going to show off the risk profile chart here in my broker, and what I want to show off is just kind of what you can expect as you kind of use the three different tiers there for hedging with options. Now, I have gone ahead and set up the scenario that we were talking about, 600 shares of the SPY with 6 put options. Now, they go out about 6 months and they have a delta of 0.4 or roughly 0.4. And we have a perfect stock hedge, right? We are using 6 put options. So as you can see, our downside is limited. We won't lose money after the stock breaks down past the strike price. So all we would really lose is potentially where the stock is now, traded down to that strike price, and then any premium that we would have paid for the put options. So that would be a stock hedge. Now, what we can do is if we raise it up to 11, which would be a delta hedge, then obviously you can see here on the purple line, it's pretty flat. We're not losing much value to the downside. So it's pretty flat as long as it stays within this range. And then if it starts to move to the upside, we'll make a little bit of money. If it moves to the downside, we'll make a little bit of money. But those are kind of the stocks moving kind of extremely. What you don't want to have happen, and this is why you kind of want to go out farther out in time when you do these kinds of positions, is you don't want to have the stock just flutter around and not move, okay? Either wanting that move down or you're wanting that move up to where you take off the hedge. You know, this is where you just need to know where your limits are, whether you're going to be back bullish or you're going to keep your hedge on back to the bearish side, okay? But as you can see, any kind of stock movement is pretty well contained for losses, okay? We're not really looking to make money on the upside or really the downside. We're just getting our delta close to 0 as possible, okay? Now, let's say we were going to overhedge, okay? So if we're going to overhedge and we buy 3 extra put options, obviously you can see that, well, we start to make money as we go farther down quicker, okay? So the more options that you're going to buy for protection on your core position, then you will make money quicker to the downside, obviously, the more put options you buy. So in this scenario, it can be advantageous to fork up that much capital if you are expecting a good amount to the downside, because if you do take off the stock position here, you know, you will make a pretty good chunk on the put options, right? And then you can roll that back into buying more shares of the stock or other assets. So like I did mention earlier, the only down part of doing this kind of strategy or hedging or anything like that is if the stock doesn't move. So this is where you definitely want to give yourself plenty of time on your hedges. You definitely want to go out, you know, 6 months at the minimum, up to, you know, a year and a half, that kind of thing, to give yourself plenty of time to see what the stock's going to do, and make sure you have your line in the sand if it's going to go back to the bull side and you want to take your hedge off, or if it goes to the bear side and you want to keep your hedge on. But if you like this explanation for how to hedge and kind of the different levels of hedging with options, you know, give the video a like and let me know down below kind of which way you prefer to hedge if you do have a preference. Alrighty, take care, Alpha Hunters.